here. So take a look at this equity curve right here. Here is last year's equity curve for this approach. And what we've done is we've gone back in time and for each year done some hypothetical testing using the rules that we've come in for a landing on. We have folks here that trade professionally, mentors that do this approach. Frank Fahey's been doing this since before anyone began teaching it, really. And I'm going to show you some equity curves year by year using the SPX, using 100,000 capital. Now, if you don't have that much, you can certainly do all of this with just a fraction of the money in the E-mini S&P options. That would be our suggestion for that. And so we're keeping each campaign with the same contract number relative to that 100,000 using the SPX cash options. All right, so in 2017, when you look, there was a return of 35.1%. And what we're doing is getting out whenever the campaign fizzles out in December, middle of the month or so, we just end the campaign there, do not put another one on until the following January when we have a qualified bar. And I'll explain that in a second. So for 2017, the last campaign ended December 19th for a total of an annualized return of 36.4. When we look at 2016 ended up having a return of almost 40 for an annualized return of 47.3, finishing up December 15th. Okay, let's go back to 2015. 2015 ended up having a a return of 40.1% as well. 3 very good years, and keeping the contract size consistent with just one certain level, at 100,000 in this case. Now, if your account grows in value, all right, you'll be able to put on more contracts. And if you were to do that, and I ran this for just 2016 through 17, combining the 2 years, increasing the contract size commensurate with your account value, all right, which could really make the returns take off. There, you can see a total return in 2 years of 111 with an annualized return of 59.9. Now, these were 2 extremely good years. Obviously, 2 very, very good years. You had 22 total campaigns with only 1 loser, and that's just outstanding. When we look at this year, though, 2018, we know that this year has been extremely volatile, both to the downside and the upside. It has been a rocky road, and a lot of people have been really burned trying to sell option premium. From any kind of a delta neutral or even a bullish perspective, it's been a rough go of it. And so what has happened to our approach in this environment? Well, there is a drawdown, but the drawdown is only at 15.4%. Only 15.4% of that 100,000. Or excuse me, no. This is with the combined where we've been increasing the contract size. So even with increasing the contract size as the account grows, now with all the market volatility we've had, because we have certain stops in place, because we have conditions at which we will not enter a campaign, that's really contributed to our drawdown being very limited. And when you're shooting for 50, 60% annualized returns, 15 is pretty good. So, just full disclosure, yeah, this year's been rough for everybody, but us I think we're doing extremely well with considering the market condition. Now, why is the approach successful like this? And 2 things contribute to it. One is that we place the positions only in such a way, using broken wing butterflies, and I'll explain this in detail. We want our position to have a positive expected return and a high probability of profit. All right, a high probability of profit. Both of those, and I'll explain those in a bit. Second, we want to place our positions and begin our campaign only when the SPX's market condition is more likely to be favorable for this type of trading. There are some market conditions we won't touch. I'll explain that as well in the future. Now, before I get to both of these elements and explain these fully. Just full disclosure, we have a Broken Wing Butterfly course. It takes 3 months. We give you 3 months access to OptionVue. There's hundreds of hours of my inside wire presentations and research that are available in that 3-month period. Also, you get 3 recorded sessions. I'm going to break this down completely, but it's a one-on-one mentoring approach where you'll meet with a mentor and we'll make sure that you're up to speed on everything I'm going to show you here today and more. Okay? More about this later. Also, if you decide to do this in the S&Ps, know that the SPX cash market trades, well, this is today's database in OptionVue. You know, we're calculating that the SPX, its daily volume, options volume, is $1.6 billion. Okay, $1.6 billion of options traded per day. The E-mini is at 78 million, not shares, but yeah, dollars on, you know, dollar volume of options traded is at 78 million there. 1.6 billion for the SPX. So, should you decide to go down this road, know that both markets have tremendous liquidity. All right, let's go after both of these here. First, the approach works because we're placing positions in such a way that the expected return is positive and you have a high probability of profit. And to understand this, you really have to go down the road of understanding these risk graphs. And I'm assuming many of you know how to read these. I'm assuming also there are some that don't. You're just beginning in options perhaps, but let me just review this graph very quickly. This is a graphic analysis, and we're showing an x-axis showing the price of the stock. In this case, the spiders. We're modeling here 100 long shares of spider shares at 274.22. If the market goes up, we move along the x-axis to the right. If the market goes down, we move along the x-axis to the left. Then we have our y-axis. This represents our dollar amount of our profit and loss. Anything above this is gain. Anything underneath it is loss, such that if the market goes up $5 and we own 100 shares, we come up here, we look at that data point, we have gained 500 right there. Market goes down $5, we take a look at that data point, we've lost 500. Okay, simple enough. Now let's take a look at a long call position, long 2 of the spider 274 calls at $4.55. We're showing 3 different time frames. T+0 is today, then halfway between now and expiration, and then the expiration line is solid. We are looking at today's dotted line such that if today price went up $5, the position would make 680. If today the market went down $5, the position would end up being down 474. Okay? Now, let's move to the time frame from 18 days out, halfway between now and expiration. Here, you can see that if the market moves up $5, the position's gained 422 instead of 680. Goes down $5, we are at minus 746. Okay, and this is the effect of time decay on a long call position. It's pretty brutal. Okay, now there's a few things here. Expected return. What is expected return? ER. Notice underneath we have a range of prices encompassed by the purple line, and then a range of prices encompassed by the little, I guess it's teal. All right. Okay, the purple line represents the range of prices within 1 standard deviation. Okay, the one with the teal line, those are prices encompassed by the 2nd standard deviation. And to calculate expected return, we take 11 data points from across the width of this bell curve at the gain and loss level. So here we have a data point here, you know, and then over here on this end, those are 2. Then we have 1 right in the middle. Okay, that's 8. Let's see, that's 3. But we need 4. We need 4 more on each side. So that we have, oh, excuse me, right here. Then we have 1, 2, 3, 4, and then we're going to have 1, 2, 3, 4. And so what we do is we look at all of those levels of gain or loss along that T plus 18 line, each one multiplied by their probability of occurrence. You average those together, and in this case, we're getting an expected return of 0, 18 days out. But the variance, okay, from all of these is huge. Here we're making a ton. Here we're losing a little. A big variance, okay, of 100. So the standard deviation of those 11 data points is at 101%. Now, probability of profit. Notice the break-even line at T plus 18 is encompassing, the profitable area is encompassing a minority portion of this bell curve. Most of it is encompassed by loss, where we're underwater. You see that? So that's what we're looking at a lower probability of profit. If we went to the expiration line now, the solid line, way out here on the edges, we have a lot of gain, you know, and here we're flatlined out at the losers. When we calculate it out, the expected return is positive because of these outliers that are making so much. But the variance of those 11 data points is quite high at 145, and of course our break even takes us so that we're making money on only 36% of the bell curve. Okay, do you know how to read this now? Hopefully you've picked this up. Let's go look at a broken wing butterfly because the picture is dramatically different. Okay, here we go. Oh, before that, price chart. In OptionVue, we have this wonderful feature where you can get a visual look at where price has to go for you to make money on any options position, no matter how complex. Here you can clearly see that price has to go up for you to make money. If it stays stagnant and doesn't move up, you're in the red, and that's the effect of time decay. All right, that you can see. If the market doesn't move and you bought calls at the money calls, okay, you're going to lose money on just sheer time decay, and that's what is represented in this picture. All right, now let's go to a broken wing butterfly. Let's define what it is. I'll show you an example, and then we're going to look at that graphic analysis screen because the picture is a lot better than that long call. So take a look at this. Leg A, B, and C. We do this only in the puts because of the vertical volatility skew. We keep it defined, refined into the puts because we're taking advantage of a naturally occurring skew like that. We go long and in the money put, all right, and then we go out of the money in the puts and sell 2 out of the money puts with a delta of roughly 25 to 35. Now there's going to be a certain distance between leg A and B, and then when we go to leg C, we're going to go way out of the money in the puts, not the same distance as leg A is to B, but farther than leg A is to B. We're going to go farther out and put that on such that that distance is quite dramatically more than what you'll see between A and B. Okay, so let's go look at an example of this. A normal butterfly is where the distance from leg A to B is the same as B is to C. They're the same, but we're going to break that off on leg C and go way out of the money. Here's an example. When SPX was at 2752, leg A could be 8 points in the money at 2760. So we're going to go, and I'm doing a 10-20-10 example here. Okay, long 10 of the in the money puts, it's 8 points in the money. Then we go out of the money to the 2700s, okay, 52 points out of the money for a total of 60 points distance from A to B. Then we go way out of the money to C, 110 points from leg B at the 2590s, so that now you have a much closer relationship from A to B than what you have from B to C. And that's what makes it a broken wing, is that you're breaking off leg C and going way out of there. When you model this, this is where the magic happens. When you model this, there's some huge advantages, and I'm going to walk you through this. We're looking at T plus 0, or today's risk line right now. Once you put this position on and begin your campaign, here you can see if the market moves up 1.3% to the upside in one day, okay, we're not losing anything here. Okay, for a lot of more of the premium sellers using condors and butters, A big move like that would be devastating to the upside, but we manage that. If the market goes down 1.3%, and it's something we've seen lately, here the position loses 1% of required capital. 1% of required capital, and that's just outstanding. When you go to 10 days out, if we let the position mature and the time decay kick in, see now that we're at the T plus 10 line, and that's right here. Okay? At T plus 10, when we calculate our expected return from across this bell curve, our expected return is now positive at 1%. The probability at 92%, you can see because the break-even is way over here, and most of this bell curve now is encompassed by profitableness, where we are above the zero break-even line, going way out there. You see that? Let's go to T plus 20 now. T plus 20. In 20 days, notice now our expected return grew to 3%. Okay, our break-even is way over here on the left. Everything to the right of it is encompassed by profitableness. That's why our probability of profit is high at 93%. Also notice that the variances in those expected return calculations is single digits at 7%. That's just outstanding. Another time frame, T plus 29. Similarly, a positive expected return, high probability of profit. Something also to watch, folks, is that on the upside, now, so often, folks trading condors and butters, and I can't tell you how many people have called us after a huge up day, a big up day in the market, and they have all this exposure on the upside because of their delta neutralness and their commitment to that. A big up day, and they're underwater. Yet, in this strategy, the way we set this up, we're actually okay. Doesn't matter how much the market goes up. And this reminds me of professional golf. I don't know if you watch golf at all. I watch it most every weekend, some of it anyway. Big fan, played in high school and all that stuff. But you know what those guys do, and this started with Ben Hogan back in the 50s, where he altered his swing so that he wouldn't snap hook it. He made sure that he would avoid, he really guaranteed himself from snap hooking the ball after he altered his swing. And so what he would do is hit the ball down the left side of the fairway and let it curve back into the middle. And he could hit this power fade with tremendous consistency. And so then later you had Jack Nicklaus when he was a kid. That was his bread and butter shot, a power fade. Okay, today you have Dustin Johnson is the quintessential power fade guy. Hit it down the left, you remove all the trouble on the left. You just manage how much of the drift you have going back to the middle. Phil Mickelson can hit a great power fade down the right side of the fairway, fading it into the left because he's a lefty. Anyway, I bring that up to say this is a similar thing where we are removing trouble on one side. Okay, so on a big up day, the rest of the world is happy, and we can be happy too because we're not losing money, we're getting some time decay, and everything's fine. But now look at the downside management that's built into this approach. Notice the T plus 0, we're kind of leaning a little bit delta long. If the market goes up, we're not going to make anything. But if it goes down, we'll lose it. We're leaning a little bit delta long, and then it flattens out. Now watch this. The next line up, we're kind of tilting it up to the left so that the position actually makes more money if it moves to the left. Then on this time frame, T plus 29, look at that. We're leaning pretty strong to the left. So there is a built-in delta adjuster making the position more delta short as the position matures. See that? So we're not concerned with the upside, and as time goes on, the position self-adjusts to give us that hedge on the downside. And that makes for a very, very effective strategy. All right, as I'm showing you, positive expected returns, high probability of profit. So I show that to you because this is critical. And when you go to the price chart and take a look at the visual aspect of this in terms of where the position makes money, you can see that as time goes on, the approach makes money even if it goes down. No matter how far up to the upside it goes, it makes money. So you can make money no matter which way the market goes. And what you'll see here, though, is indeed the approach does lose money if the market drops precipitously right at the beginning. Okay, and that brings us to the second point: placing positions only when the SPX's market condition is more likely to be favorable for this approach. So we're just going to look at times in the market condition where it's less likely to take a dive like this. We want to avoid those conditions where we have this nastiness on the downside. Okay, so here's what we've done, and I want to just point this out. Many folks that teach income strategies will pretty much have the attitude that you can put these strategies on no matter what the market does, because if you have a robust adjustment method, you're good. And that if you just have the proper, and I'm going to call it market jujitsu, options trading jujitsu, where you have the tricks to finagle your way out of anything, and some folks will call it a craft, a well-developed craft. You know, we treat it more like a science. Okay, and a lot of the science comes in at the beginning, choosing when to get in and begin your campaign. It's like real estate developers or builders. You know, I'm involved with municipal government, and I deal with developers all the time. You know when developers make their money? It's when they buy the property. Okay, their money is made at the beginning when they factor in their profit right up front. And a lot of prep work goes in before they ever break ground. They know what's going on. The bad developers and the bad builders are those that go in, overpay at the beginning, and then they're scratching after that. And so what we do is we do a lot of preparation, and we know when the market is more likely to be volatile in the future than not. We've researched and documented this. This is part of the course we teach. We show you exactly what technical indicators to use and combine to give you the best lead in getting in the market when it's more likely to be favorable for this kind of trading. And here what we've done is I've labeled the bars blue and red. Red are those bars that would be disqualified from consideration for our approach. The blue bars are the bars that would be technically qualified for trading in our approach. And you might look at this and go, boy, you know, I could probably throw on a moving average and knock off a lot of those red bars. And you would be correct. You could throw in a 50-day simple moving average and take a peek here. And indeed, there's a lot of red bars underneath that 50-day simple moving average. And that is one of the technical indicators we use. We use a couple others. You can see that there are some red bars above the 50-day simple that are warning us to not get involved. And we teach those in the course as well. But if you take anything away from today, all right, besides, you know, a desire to, you know, take our little mini course, it's that if you were to trade this approach, condors or butters, only when the market is above the 50, that would save you a lot of grief. Trading this approach when the market is under the 50, all right, becomes more problematic, and statistically, it's a poor proposition. Okay, we've refined that more, but that's just, you know, one good line in the sand to at least begin with. And we've done a lot of work on that, and of course, you would be able to look at the research we've done should you take the mini course. Again, this is our equity curve for the last 2 years plus through April or so. I wanted to show you too. We have this 15% drawdown, and it works out to an annualized return. I was putting this together. I wanted to get last month, and our annualized return for the 3 years turns out to be roughly 37% annualized return, inclusive of the drawdown that we're in right now. So I just wanted to make that clear. I was hard pressed this morning to get in the testing because we just wrapped up the month not last night really, and but I accidentally put this date too far in the past, and that messed up the annualized return anyway. Okay, finally, to enroll in the class, if you want to do it online, first, if you have any questions, please give us a call. You can talk to the folks here, 847-816-6610. Online, you go to OptionVue.com, click on the store Discover Options Personal Mentoring. It's $999. You get 3 courses. These are recordings where we assign homework, and then you meet with the mentor over the phone for an hour, talking with them about the approach, going over your homework, answering all your questions, making sure that you have all the concepts down. Okay? First, we have the proper timing, where I explain all those technical indicators, the research behind it, and the whole philosophy there. Then we have broken wing butterfly campaigning that goes through all the rules, the stops, the profit targets, the target levels, everything. Then we have a money management component as well. Now, full disclosure, this assumes you are an intermediate level options trader. Okay, we're assuming you understand volatility to a strong extent, the difference between implied and realized volatility or actual volatility. Also the Greeks, we assume that you have some rudimentary knowledge of the Greeks, delta, gamma, theta, vega, as it relates to options. Otherwise, if you're kind of just starting out at a beginner level, call us up at that number, because we have another full mentoring course to take you from a beginner to an advanced level that would give you some of that background knowledge you need to come in and take the mini course. But this mini course would be included, of course, in our full mentoring. All right, but you meet with a mentor, you do conferencing software, our mentors will look over your shoulder to make sure you're getting the concepts down. You get full use of OptionVue for 3 months, and also you get access to 500 of my Inside Wire presentations, including the research portions last fall where I came in for a landing on the best way to trade these broken wing butterflies. And there's just hundreds of hours of recordings that we've done, all archived going back really to 2008, I think. Tremendous material there. Okay. Any final questions? I know Jim's been hard at work answering those questions. And let's see. Yeah, Henrik, no, we're working on back testing, and I went back to 13. You should know that for the research work we did in terms of timing the entry of these, we go back to Jan of 2000 when we run that research level. But we're making our way, doing back-tested campaigns. I just posted 2013 today in my Inside Wire class, and we're working backwards, getting it going. But you're right. Those are in bull markets. But listen, in a bear market, you're under the 50-day simple moving average, right? And so you're not trading this approach. You're just out. You're in cash waiting for the market to get above the 50. That's just now we throw in a few others that are very valuable and needed in in timing the entry of the campaign. But just understand that in a true bear market, you're under the 50 and you're not really. It's very likely you're out and just in cash during that time. Okay. How long is each trade? Well, each campaign, I'm going to say, is probably 30 to 40 days that you're in, something like that. Okay. Just seeing other questions here. A lot of times people are typing, and I see a little note saying that this person's typing, and then they have to click send, and then I know it. Here we go. Do you have strangles when being under the 50? Do you have strategies when being under the 50? In some conditions, yes. There are some, we have an approach that we teach in our core mentoring approach, hedged bull put spreads, which is more of a raw bullish type approach. We've done a lot of work with hedged bull put spreads, and that's something that is part of our core curriculum. Maybe we'll have a mini course in the future on that, but right now that's just one of the strategies we teach in our equities track mentoring that you can see on our website at DiscoverOptions.com. Now, that's certain conditions under the 50, okay? Obviously, when the market's under the 50 and it's looking bullish, that's when you would have a good time to put on a hedged bull put spread. But we have a very specific way of doing that. Instead of just a raw credit spread, we found some value in doing a hedged credit spread, a hedged bull put spread. And that's because of the skew in the puts, just as an aside. Okay. Awesome. Folks, thanks so much for joining us. And again, if you're interested, and we hope you are, please give us a call. Look on the website for more info. Take care. It's been a pleasure. Bye-bye.